Did you know that there's a way to escape the 9-to-5 grind and live life on your terms? Imagine waking up every morning, not to an alarm clock, but to the sound of dividends pouring into your bank account. It's not a dream. It's a financial strategy that can set you free. In this video, we'll explore the fastest way you can live off dividends. So if you've ever wondered how to achieve financial freedom through smart investing, you're in the right place. In the next few minutes, you'll learn the incredible benefits of living off dividends. I'll share with you a sample dividend portfolio, where to find dividend stocks, and calculating your investment needs. So, let's waste no time and dive right in. Before we dive into the world of dividend investing, let's start by defining what we all can agree on as passive income. Passive income is income received without any effort on part of the recipient. Now, there are a few investments that fit this definition. Take, for example, interest-bearing investments like certificates of deposit and U.S. Treasury securities might come to mind. While they do offer a form of passive income, the only problem is that most of these securities currently pay interest rates well below 1%. That's hardly enough to support a comfortable lifestyle. Rental real estate is another way of generating passive income, but it's not entirely hands-off. You'll need to manage the property and deal with tenants to produce that monthly income. It's more like a semi-passive income. Now, here's where dividend income comes into play, and it's truly in a class by itself, especially in this era of incredibly low interest rates. You can create a portfolio of stocks that provide steady returns of 3% to 4% per year without any effort on your part. Imagine receiving $1,000 per month in dividends, and the best part? Once it's up and running, you won't have to lift a finger to make it happen. Your investments will work for you, providing a generous income stream without you actively working for it. That's right. It's the best example of a genuinely passive investment you can find today. So, how much do you need in your portfolio to live off dividends? Let's explore that next. Before we continue, let me explain how to calculate a dividend yield. We'll be using this term a lot in this video. Dividend yield equals annual dividends per share divided by price per share. For example, if a particular stock has a price per share of $100 and pays $10 in dividends a year, its dividend yield would be $10 divided by $100 equals 10%. Now, let's calculate your investment needs. To begin, you must determine how much income you need each year to support your desired lifestyle. To calculate this, you should start by looking at your current income and expenses. If your current income is enough to sustain the lifestyle you want in retirement, that's a good starting point. However, remember to factor in potential future expenses like inflation and increasing medical costs as you age. Keep in mind that most dividends are paid out quarterly, so you may not get regular monthly income unless you have a variety of dividend-paying stocks with staggered payout dates. Let's look at the size retirement portfolio you'll need to live off dividends. The table below shows how much you'll earn at 3% and 4% annual dividend yield, with a portfolio of $500,000, $1 million, and $2 million. Details: portfolio size, dividend yield, annual dividend income. Example 1. Portfolio size, $500,000. Dividend yield, 3%. Annual dividend income, $15,000. Example 3. Portfolio size, $1 million. Dividend yield, 3%. Annual dividend income, $30,000. Example 6. Portfolio size, $2 million. Dividend yield, 4%. And annual dividend income, $80,000. Let's illustrate this with an example. Suppose you determine that you need $50,000 per year to live comfortably, and your average dividend yield is 5%. To estimate how much you need to invest, simply divide your required income by the average dividend yield. In this case, it would be $50,000 divided by 0.05, which equals $1 million worth of shares to meet your income needs. Remember that dividends can fluctuate from year to year or even quarter to quarter. This means you can't simply invest your money and forget about it. You want to keep a close eye on your portfolio to ensure you're always getting the best return for your money. In my above example, I got a result of $1 million in investments. Now, that is a lot. That's why it's important to start saving and investing as soon as you can, so you can give yourself the best chance of reaching your goals. Some might argue that $1 million alone could be enough to sustain a decent retirement. But here's where the power of living off dividends truly shines. With dividend income, you don't have to touch your principal investment to pay your bills. It means you always have that nest egg of investments to rely on in case you need it for unexpected expenses or emergencies. Moreover, none of us can predict exactly how long we're going to live or how long we'll need our savings to last in retirement. By living off dividend income alone, you create a financial safety net that can meet your needs more or less indefinitely. You're not depleting your principal. Instead, you're living off the income generated by your investments. This is why dividend investing is often considered one of the most secure paths to financial independence. So, how do you get started with dividend investing? There are 3 basic approaches that you can consider. Start with dividend aristocrats. First, you can start by looking into a category known as dividend aristocrats. These are companies that have consistently increased their dividends for at least 25 straight years. They are typically large, established companies that are a part of the S&P 500 index. But here's the catch. Being on the list of dividend aristocrats doesn't guarantee a company is a good investment. It's essential to do your research. The list changes over time, with new companies added and others dropped, so it's not a permanent status. However, it can be a valuable starting point to find some of the best, most stable candidates for your dividend portfolio. Currently, there are 65 companies that meet the criteria for dividend aristocrats. To qualify as a dividend aristocrat, a company must increase the dividend it pays to shareholders for at least 25 consecutive years, have a minimum market capitalization of at least $3 billion, and have an average of at least $5 million in daily share trading value for the 3 months prior to the rebalancing date. Now, while dividend aristocrats can be a great place to start, it's essential to diversify your portfolio and not rely solely on these companies. Another effective way to invest in dividend stocks, especially if you prefer not to hold individual stocks, is by considering high dividend exchange traded funds, or ETFs. These ETFs are designed to specialize in dividend-paying stocks, offering you a diversified approach to dividend investing. Here are a few examples of high dividend ETFs. Vanguard High Dividend Yield ETF, VYM. This ETF currently has a dividend yield of 3.68% and has delivered an overall average return of 10.45% over the past 10 years. SPDR S&P Dividend ETF, SDY. This ETF offers a current dividend yield of 2.91% and has shown an overall average return of 10.23% over the past 10 years. Schwab US Dividend Equity ETF, SCHD. This ETF currently provides a dividend yield of 3.69% and has delivered an overall average return of 12.61% over the past 9 years since its launch in October 2011. One interesting thing to note is that all 3 of these funds not only offer current yields significantly higher than interest-bearing investments, but have also demonstrated double-digit overall returns for the past decade. While these funds may not make you rich overnight, like high-flying growth stocks, they offer something equally valuable: steady, reliable returns. If you're a long-term investor looking for investments that can stand the test of time, these dividend-focused ETFs should dominate your portfolio. The third approach to investing in dividend stocks takes us into the world of real estate investment trusts, commonly known as REITs. Think of a REIT as a mutual fund that invests in real estate instead of stocks. But not just any real estate. REITs primarily focus on commercial properties, which can include office buildings, retail spaces, warehouses, large apartment complexes, and similar properties. One of the standout features of REITs is that they are legally required to pay out a minimum of 90% of their income in dividends to their shareholders. This income compromises a mix of net rental income and capital appreciation distributions from properties that they've sold. And to keep things simple for investors, REITs often pay dividends on a monthly basis. Now, if you're interested in REITs for high dividend income, Here are a few worth considering. Brookfield Property REIT, BPY, which currently offers a substantial dividend yield of 8.32%. Kimco Realty Corp., KIM, which currently provides a dividend yield of 2.81%. Brandywine Realty Trust, BDN, which currently offering a dividend yield of 7.28%. However, it's essential to be aware of the potential risks associated with REITs. While they may offer high dividend yields, the long-term price performance of some REITs has not been as favorable in recent years. For instance, both Brookfield Property REIT and Kimco Realty Corp. Have experienced significant declines in their share prices over the past decade, despite paying consistently high dividends. Brandywine Realty Trust has held relatively flat in terms of capital appreciation over the same period. So, if you're considering investing in REITs, it's crucial to do your research and understand the unique dynamics of the real estate market. While they can provide excellent income, their capital appreciation may vary. And there you have it, folks. Your comprehensive guide to the fastest way you can live off dividends. Don't forget to smash that subscribe button and ring the notification bell so you never miss out on the wealth building content we share on this channel.